For decades, silver was told where it could go, how fast it could move, and who was allowed to win. But markets don't break when people are watching charts. They break when structure fails quietly, when paper promises meet physical limits, and confidence leaves the room before price does. Right now, something is changing beneath the surface. Price dips are no longer calming the market. They're accelerating behavior. Delivery is being chosen over exposure, urgency over patience. And when a market stops asking for permission, it doesn't announce it. It reprices everything. The question is not if silver is breaking free. The question is, who understands it early? And who realizes it only after the door is closed? Welcome to Boring Currency Ledger. If you have lived long enough to see cycles repeat, promises fail, and systems change their rules quietly, then this channel was built for you. If this analysis adds clarity to how you see markets, consider subscribing, not for excitement, but for understanding that compounds over time. And before we go deeper, tell us something real in the comments. From where in the world are you watching today? For decades, the silver market appeared calm, predictable, and well-managed. To most business leaders and entrepreneurs, it looked like a mature system, one where prices moved within known ranges, risks could be hedged, and supply was assumed to be reliable. This sense of order was not accidental, it was designed, and for a long time it worked. They built the modern silver market on confidence rather than contact with the metal itself. Price discovery slowly shifted away from physical exchange and into paper systems. Futures contracts, options, and other instruments that represented silver without requiring it to move. Trading volume expanded rapidly, while physical silver changed hands quietly in the background. For businesses, this created comfort. Prices were always visible. Liquidity appeared endless. Silver became something that could be accessed with a click rather than handled, stored, or delivered. As long as contracts settled and volatility remained contained, few questioned what stood behind the price. But stability can be deceptive. In markets, long periods of calm often hide growing imbalance. Each paper contract increased efficiency, but it also increased distance between price and supply, between risk and reality. Over time, participants stopped asking what backed the system. The quoted price became truth. The structure relied on one critical assumption: that physical silver would always be available when needed. The system did not require everyone to take delivery. It only required most participants not to ask for it. As long as contracts could be rolled or settled financially, the illusion held. Yet systems built on trust rather than surplus are fragile. They do not collapse suddenly, they weaken quietly. Early signs appeared when price behavior stopped matching demand behavior. Price dips no longer reduced pressure. Instead, they attracted buyers who treated lower prices as opportunities to secure metal. In a healthy commodity market, lower prices ease demand and allow supply to recover. In silver, the opposite began to occur. Physical buying intensified during weakness. Inventory moved out faster. These were not emotional reactions. They were rational responses to concern about future access. The illusion of control also depended on the belief that large institutions could manage any imbalance. History supported that belief until structure changed. Industrial demand expanded steadily, turning silver into a critical input rather than a financial side asset. Unlike traders, industries cannot wait or substitute paper claims for metal. As industrial use grew, the margin for error shrank. The market required tighter coordination between paper promises and physical flow. Any disruption carried greater consequences. Confidence became the real anchor holding the system together. But confidence responds to behavior. When participants observe others choosing ownership over exposure, trust weakens. When delivery feels less certain, assumptions change. One request for delivery becomes two. One delay becomes remembered. This is how structural illusions fail, not through panic, but through choice. Small decisions accumulate, pressure builds quietly. The market does not announce a breakdown, it simply stops behaving as expected. For business leaders and entrepreneurs, this moment matters. Markets rarely fail at peak fear. They fail after long periods of misplaced confidence. When calm is maintained by belief rather than surplus, calm itself becomes risk. The silver market's behavior suggests that control is no longer absolute. And when control depends on trust, once trust shifts, repricing follows, not gradually, but structurally. For a long time, the silver market operated like two separate worlds that rarely touched. One world was fast, digital, and abstract. Prices moved on screens, contracts changed hands in seconds, and exposure could be bought or sold without ever seeing a bar of metal. The other world was slow, physical, and constrained. It involved mines, refineries, transport, and storage. For years, these two worlds coexisted without conflict. That balance is now under strain. Paper liquidity created the impression of abundance. In theory, silver could always be accessed because contracts were plentiful. For traders and financial institutions, liquidity meant flexibility. Positions could be adjusted, hedged, or closed without friction. This worked because most participants treated silver as a financial instrument, not a physical necessity. But physical reality does not scale the way paper does. A contract can be created instantly. A bar of silver cannot. It must be mined, processed, shipped, and stored. Each step takes time, energy, and capital. When demand is steady, the system functions smoothly. When demand shifts suddenly or structurally, stress appears. The collision begins quietly. It starts when physical users behave differently than financial players. Industries that rely on silver for production do not speculate on price alone. They focus on continuity. Their primary risk is not volatility, but interruption. When availability feels uncertain, their response is not to wait. It is to secure supply. This is where the paper market loses influence. Price signals that once guided behavior begin to fail. Lower prices no longer reduce demand. Instead, they accelerate it. Physical buyers step in because price no longer represents risk. Access does. This reversal confuses those who rely on historical patterns. Paper liquidity assumes optionality. Physical demand does not. A factory cannot roll a contract forward if metal is not delivered. A supply chain cannot pause because a chart suggests patience. When paper markets send signals that contradict operational reality, physical reality wins. As this collision unfolds, certain behaviors become visible. Delivery requests increase. Settlement timelines matter more. Participants pay closer attention to inventory movement rather than headline prices. These are not emotional reactions. They are rational responses to constraint. The system was never designed for widespread delivery. It was designed for efficiency under the assumption that most participants would settle financially. That assumption held when confidence was high and alternatives were abundant. It weakens when uncertainty grows. This is not about conspiracy or control. It is about structure. Paper markets are excellent at distributing risk and information. They are poor at producing material. When too many claims compete for limited supply, prioritization occurs. Those who need the metal act first. Those who only want exposure are forced to adjust. Entrepreneurs often misunderstand this phase. They see volatility and assume instability. In reality, volatility is a symptom of repricing pressure. It reflects disagreement between systems, not collapse. The danger lies in mistaking noise for resolution. Physical constraint introduces friction. Friction changes incentives. When access becomes uncertain, price becomes secondary. This is when premiums appear, delays increase, and availability matters more than benchmarks. These are early indicators, not conclusions. Another mistake is assuming that paper liquidity guarantees exit. Liquidity works best when few people need it at the same time. When conditions change, exits narrow. What was once effortless becomes conditional. This is not failure, it is prioritization. The collision between paper and physical does not produce a clean break. It produces confusion. Prices may move sideways while availability tightens. Headlines may suggest calm while behavior suggests urgency. This disconnect is where misjudgment thrives. Experienced decision-makers understand that markets are not just mechanisms, they are agreements. They function because participants accept certain assumptions. When assumptions shift, markets reprice to restore balance. This process is rarely smooth. The silver market is now navigating that transition. Paper liquidity still exists, but it no longer tells the full story. Physical reality is asserting itself through behavior rather than announcements. Those watching only prices miss the signal. Those watching flow understand the risk. This phase rewards preparation, not prediction. It punishes complacency more than error. Businesses that rely on assumptions of infinite access face exposure they did not model. Those who recognize constraint early gain optionality while it still exists. Part 2 ends with a critical insight. When paper systems collide with physical limits, the outcome is not negotiated. It is enforced by reality. Markets adjust not to opinion, but to availability. When markets are stable, institutions appear confident and disciplined. Their actions look deliberate. Their messaging sounds calm. Risk seems contained, but when pressure builds beneath the surface, behavior changes first, long before public narratives do. This is where careful observers gain insight, not from what institutions say, but from what they quietly do. In the silver market, stress does not announce itself with alarms. It reveals itself through small, repeated decisions. Large players begin to protect access rather than chase returns. They shift from offense to defense. This transition is subtle, but it is consistent. Institutions are not emotional. They operate on incentives, constraints, and risk models. When those models start producing uncomfortable outcomes, adjustments follow. These adjustments are rarely explained publicly. Instead, they appear as patterns, changes in positioning, altered settlement preferences, and unusual persistence. One of the clearest signals under stress is repetition. When the same action is taken again, and again with diminishing results, it suggests necessity rather than confidence. In a calm system, interventions work quickly. Under stress, they must be repeated. Each repetition reveals less control. In silver, attempts to manage price behavior have not produced the expected response. Price pressure no longer cools demand. Instead, it attracts it. This forces institutions into a reactive posture. Reaction is expensive. It consumes capital, reputation, and flexibility. Another signal appears in timing. Institutions under stress act earlier than usual. They shorten planning horizons. They prioritize immediate outcomes over long-term optimization. This is not panic. It is risk containment. When future conditions feel uncertain, present control becomes valuable. Delivery behavior also changes. Under normal conditions, many participants prefer financial settlement. It is efficient and flexible. Under stress, delivery becomes a form of insurance. Taking possession removes dependency on counterparties. This shift is quiet but powerful. Backward-looking analysis often misses this point. Observers focus on price history and assume repetition. Institutions focus on exposure and assume adaptation. When these perspectives clash, misinterpretation follows. What looks like noise to one group looks like warning to another. Trust plays a central role. Financial markets are built on trust in processes, timelines, and obligations. When trust weakens, even slightly, behavior adjusts. Participants ask fewer questions publicly and take fewer risks privately. They do not broadcast doubt, they hedge against it. Institutional stress also shows up in silence. When clear explanations disappear and vague language increases, it signals uncertainty. Precision fades when conditions are no longer stable. This is not deception, it is limitation. Clear answers require stable assumptions. Another overlooked indicator is preference. When institutions favor certainty over efficiency, stress is present. Certainty costs more. It reduces optionality. No rational actor chooses it without reason. When many do so at once, the reason is systemic. Importantly, this phase does not require failure. Markets can function under stress for extended periods. What changes is fragility. Small disruptions have larger effects. Margins for error narrow. Coordination becomes harder. For entrepreneurs and business leaders, this distinction matters. Waiting for visible crisis is often too late. By the time stress becomes obvious, options are limited. Institutions move early because they must. Smaller players move late because they wait for confirmation. Another mistake is assuming that institutional power equals immunity. Scale provides leverage, not invulnerability. Large entities manage exposure differently, but they are still subject to constraint. In some cases, scale amplifies risk because positions are harder to unwind. This is why institutional behavior is more informative than commentary. Public statements are designed to maintain confidence. Private actions are designed to manage risk. The gap between the two widens under stress. The silver market now shows signs of that gap. Behavior is adjusting faster than narratives. Access is being prioritized quietly. Risk is being redistributed without explanation. These are not dramatic events. They are structural signals. When a market begins to shift at the structural level, the greatest risk is not price movement, it is misjudgment. Business leaders, investors, and young entrepreneurs often focus on where price might go next. But experienced decision makers understand that access, reliability, and counterparty stability matter more than short-term valuation. The silver market's changing behavior offers a broader lesson about capital, supply chains, and trust-based systems. This is not only a story about metal, it is a case study in how modern markets react when confidence weakens and physical constraints tighten. For businesses that rely on commodities, one key question becomes urgent. Is exposure enough, or is ownership required? Exposure offers flexibility, but ownership offers certainty. In stable times, flexibility feels superior. In unstable times, certainty becomes strategic. Many firms assume they can secure resources when needed because markets appear liquid. However, liquidity can vanish when demand concentrates or delivery tightens. What looks like abundance in normal conditions can quickly become scarcity under stress. Businesses that fail to plan for this risk may discover that access is no longer guaranteed. Another critical factor is counterparty dependence. Paper contracts rely on the performance of intermediaries. If financial conditions tighten, settlement rules change, or regulatory pressure increases, contractual rights may not translate into immediate access. This does not imply collapse. It implies delay, repricing, or prioritization. For operational businesses, even small disruptions can carry real costs. Volatility also presents a psychological trap. Entrepreneurs may interpret rapid price changes as signals to exit or delay decisions. In reality, volatility often reflects disagreement between systems, not fundamental weakness. Those who confuse movement with meaning risk acting at the wrong moment. A disciplined approach requires separating signal from noise. Headlines tend to amplify emotion. Structural shifts develop quietly. The leaders who perform best during transitions are those who monitor flow, availability, settlement behavior, and real-world constraints, not just charts. Another mistake lies in historical overconfidence. Many market participants assume that the future will mirror past cycles. They compare current conditions to previous peaks, crashes, or corrections. While history provides context, it does not guarantee repetition. Structural conditions evolve, demand patterns change, supply chains adapt. What worked before may not apply again. Capital allocation decisions also deserve scrutiny. Some investors chase short-term price movements, assuming liquidity will remain available when they choose to exit. Others focus on long-term positioning but underestimate near-term disruption. Both approaches carry risk if structural change accelerates. Strategic capital allocation in uncertain environments favors resilience over optimization. This means maintaining flexibility, diversifying exposure, and avoiding reliance on a single assumption. It also means preparing for outcomes that feel unlikely but carry high impact. For young entrepreneurs, the silver market's transformation highlights a deeper principle. Markets reward preparation more than prediction. Trying to time exact turning points is less effective than building systems that can adapt under pressure. Strong strategies are built on stress tolerance, not perfect forecasts. Another implication concerns trust in financial infrastructure. Modern markets depend on intermediaries, clearing systems, and regulatory frameworks. These structures generally function well, but they are not immune to pressure. When systems tighten, friction increases, transfers slow, requirements change, access narrows. Businesses that have never tested these systems under strain may be surprised by how quickly conditions shift. Planning for smooth conditions alone is not sufficient. Planning must include scenarios where processes become slower, more expensive, or more restrictive. There is also a reputational dimension. Institutions and firms that appear stable during stress tend to attract capital and partnerships. Those that react impulsively or appear unprepared lose confidence. In transitional markets, perception of stability can become a competitive advantage. For capital allocators, the central question becomes one of structure rather than speculation. Instead of asking, where will price go? A more useful question is, how will access, settlement, and risk behavior change if conditions tighten further? This reframing encourages strategic thinking over reactive behavior. The silver market's current phase illustrates how quickly assumptions can become outdated. Paper pricing can remain active while physical access tightens. Headlines can suggest calm while behavior suggests urgency. Those who rely only on surface indicators may misread the environment. Ultimately, the lesson is not about fear. It is about awareness. Markets rarely offer clear warnings before shifting. They offer patterns, inconsistencies, and quiet signals. Leaders who learn to recognize these patterns gain an edge, not by predicting exact outcomes, but by avoiding preventable exposure.